Finance folks, the next piece of puzzle in the new IFRS 15 and IndAS 115 Revenue Recognition Standard is calculating the transaction price. That is, the value of consideration to be recorded in the books. In the next 5 minutes, IFRS and IndAS industry expert Mr. Ramanujam Narayan explains the third step of revenue recognition with the help of an interesting case study between Sony India and Vijay Sales.
Which are the several factors, for example, which are the several factors that influences a particular consideration? When does a consideration get changed? CIFRS FOB and several self-life expired, okay? CIFRS FOB and several transactions what you're talking about, that basically talks about the pricing changes, the way in which you will price to the customer. What I'm trying to say is which are the factors that influences a transaction price itself. For example, volume discounts. Many of you told about discounts. Now discounts can be in several forms. It can be in the form of rebate in some industry. It can be in the form of productivity giveback. When it comes to IT and ITES, there is a concept of productivity giveback. Have you heard about it? Productivity giveback. So productivity giveback is a very simple example that in a BPO industry, if a particular job is being done by say 100 FTs, 100 employees, next year the customer will expect that if at all, if it is being done by 100 employees and if I am giving you 100 FT business, then the next year this 100 FT work should be done by 95 FTs. So in the next year, I'll probably bill only to the extent of 95 FTs. I will not bill for 100 people. That is basically a concept of productivity giveback. Okay. Now let me talk about volume discount. In IT industry or in any other industry, I'll say that, if at all the customer will come and say, I will give you business of $1 million. I'll give you business of $1 million. But if I give you business of $1 million and more, you will have to give me 2% discount. 2% discount in the form of volume discount. Okay. Have you heard about this volume discount? It is there in every industry. Am I right? Now this 2% discount, for example, there is a 1 million revenue target milestone for giving volume discount. It's a 1-year target. As of March 2021, from January to December, the target is 1 million. For Jan to March, I have done a revenue of 300k. 2% is volume discount. As at 31st March, what is the revenue that you will recognize in the books? 2% is the volume discount. If I cross a revenue of 1 million, okay, you have achieved 300k USD as of March. How much revenue will you recognize as of March? It is less than 2%. Absolutely. Okay. So what I have to do is, so basically if I am doing 300k in one quarter, what is the total expected sales for complete year? 1,200. If I am going to do 1,200, I'll have to give 2% volume discount. On day one, if I am anticipating that I am going to give this 2% volume discount at the end of the year, does it make sense to account for the 2% from day one as a principle of prudence? Makes sense? Okay, because you have to estimate the sales for the entire year. This is the settled industry practice in every industry. In every industry it happens, and basically the management and the delivery team or the sales team estimates what is going to be for the full year, the estimated revenue, and accordingly adjust the revenue from day one. Is it understood by everyone? So these are the ways in which variable consideration gets changed: price concession, volume discount, and rebates, refunds, credits, incentives, performance bonuses. These are the givebacks that basically be given to the customers. It is like best information available with us. Absolutely, Jitendra. Okay, there are two approaches. One is expected value. Second is expected output. One is expected value. Second is expected output. One method is where there can be a possibility of giving one amount as a giveback, like a performance bonus. That if at all you fulfill a particular contract, you get a performance bonus of $1 million. Is a promise that you give it to the customer. In that case, it is basically the expected output. Second method is where there is a portfolio of contracts, which typically happens in IT and ITES industry, where you take an entire portfolio of contracts and accordingly estimate the volume discount and adjust the revenue from day one. These are the ways in which, like a price concession, refunds, credit, incentives, performance bonuses, where your transaction price will undergo a change. Expected value, and most likely amount. Expected value appropriate where an entity has a large number of contracts with similar characteristics. Most likely amount appropriate where an entity has only possible outcomes or very small number of contracts having similar characteristics. Sony sells 1000 headsets to Vijay Sales for 100 per headset. Sony provides the price protection to Vijay Sales by agreeing to reimburse Vijay Sales for the difference between this price and the lowest price that it offers for that handset model during the following 6 months based on Sony's past experience. With similar arrangement, it estimates the following outcomes. Price reduction in next 6 months, 0, 70% probability, 50, 20% probability, and 100, 10% probability. Okay? So, Sony determined that the expected value method provides the best prediction because it is a portfolio. Of course, thus it estimates the transaction price to be INR 480 per headset, that is 500 into 70% plus 450 into 20% plus 400 into 10%, that is the price reduction based on the probability. Okay? Understood? It is only a brush through what I have given in the form of example from a price standpoint.
That was Mr. Ramanujam Narayan simplifying a complicated IFRS concept for you. To understand the business implications of IFRS and IndAS in such a holistic manner with the help of real-world case studies, log into our website in the description below. And for more such interesting content, subscribe to this channel now.